One of the largest problems globally is the underfunded pensions. It is all over the globe, not just the US or the European Union. It is literally everywhere. And it is $400 trillion in underfunded pensions or more. So recently, we've seen in the last couple weeks stories about CalPERS, which is the largest pension fund in California, also the largest pension fund in the United States, talking about how underfunded CalPERS is, despite the stock market being in a bull market for over a decade, a record long expansion and bull market for US stocks. In spite of that, CalPERS is still drastically underfunded, and they're getting desperate about what to do about it. So what is CalPERS planning on doing about it? Well, their chief investment officer, or CIO, gave some outlines about what they're planning on doing, and it is not good. It is very risky. It is very dangerous, but I guess desperate times call for desperate measures, or CalPERS is planning on doing really, really risky things and then, I guess, hoping for a bailout. So what CalPERS is planning on doing is a massive amount of borrowing, 20% of their total assets. So this is like hedge fund level. No pension fund in the United States, I think ever, no pension fund ever, let alone pension funds in the United States, has ever gone to these levels of leverage before. And also, CalPERS is planning on investing even more into private equity. And let me talk about why that's probably a bad idea, especially given the timing. This article came out this month in June about how a lot of money is retreating into private equity. There's just one problem with that. The problem, according to hedge fund manager Tavi Costa of Crescott Capital, is that, as you can see here with his tracking of venture capital, which also represents private capital, how well venture capital and private equity has had similar returns over the last 10 to 12 years, that it is getting really, really, really late in the cycle. Also, past performance does not indicate future performance. So this is something that even financial professionals, but especially retail investors, are guilty of. They tend to look at past performance way too much, and past performance does not guarantee anything in the future. Well, it seems that CalPERS appears to be a victim of this type of thinking, this type of recency bias or confirmation bias, tunnel thinking, that just because private equity has done very well now for a decade, that will continue. And what Tavi Costa is showing here, and yes, it's venture capital and private equity, there's some differences, but just because private equity has outperformed for a while now does not guarantee that that will continue. And yet CalPERS is going to allocate substantially more to private equity. So another thing that people are not aware of, and I did some digging on this, is that private equity actually, they were spending a lot of money on lobbying over the last few months. They actually did get backdoor bailouts. So they weren't directly from Congress. They were from the Health and Human Services for some of their healthcare company investments. So now we get on to this article by Leo Kolivakis. I guess I pronounced that name all right. He tends to track pension fund investments, and I highly recommend reading this article because he goes through the investment strategy of pension funds and what CalPERS is now planning on doing. So no, like I said earlier in the video, no pension fund has ever used 20% leverage, leveraging up the total assets on their balance sheet 20% before. So Canadian pension funds have leveraged up balance sheets, I think 5%, but CalPERS is going 4 times more than that. An absolutely enormous amount of leverage, or about 80 billion based on current assets. And they're hoping to juice returns, but this is very, very dangerous. Also, the other dangerous thing about this is the type of trading strategy that CalPERS wants to use. And that is risk parity. So risk parity, if you're not familiar, is the trading strategy that billionaire hedge fund manager Ray Dalio of Bridgewater invented, where it's mostly stocks and bonds, but then the bond part of the portfolio is heavily leveraged up. And the claim is that this improves returns and tries to smooth out returns. However, a lot of large hedge funds, including Bridgewater, needed bailouts in February and March of this year using the risk parity and basis trading strategies. So apparently, CalPERS now expects that over the long run, the risk parity trading strategy will get them better returns. But the odds of blowing up, and comments from the CalPERS chief investment officer seem to indicate that the odds of blowing up are very low. But we know only a few months ago that a lot of hedge funds using risk parity did blow up. So it's very dangerous. They're going to be leveraging up their bond trades, leveraging up their balance sheet, acting like a hedge fund. And this is the danger we have now in society. We have central banks acting like hedge funds. We have large banks acting like hedge funds instead of doing actual lending into the real economy. And now we have the largest pension fund in the US acting like a hedge fund. And again, this is going back showing the stories of how hedge funds were bailed out in March, hedge funds who use the risk parity and basis trading strategies. So CalPERS is playing a very dangerous game. It's heads we win, tails you lose, where I guess if they leverage up their balance sheet, they'll get to keep the returns that they make, but they're clearly hoping, I think, for a bailout. Because you can only raise in Sacramento, the capital of California, taxes so much before it starts to hurt the real economy, even though politicians don't really understand that or believe that. But at a certain point, it just ruins the returns coming from taxes or raising taxes, just hurts the economy so much that businesses shut down, businesses leave the state. You're already seeing that in California. So CalPERS now is going to start acting like a hedge fund. Finally, and this is very interesting, I did some more digging on this, that the chief investment officer of CalPERS was also involved at China's State Administration of Foreign Exchange, or one of their sovereign wealth funds called SAFE, where he helped manage $3 trillion in currency reserves. Now, I don't know if that real number is still 3 trillion, but if you're familiar with how things actually work in China, normally to get a position that high in China, you have to be a Chinese Communist Party member, or you have to have something that the Chinese government wants. And hedge fund manager Kyle Bass has talked about this, where when Jack Ma, according to a lot of people, Jack Ma was forced out of Alibaba, and Kyle Bass has said publicly that Jack Ma had to hand over controlling ownership of Alibaba to 5 unnamed people, all with the same address. So Jack Ma was basically forced out of Alibaba, and now you have running CalPERS using this very risky hedge fund trading strategy that did blow up only a few months ago, that people are claiming didn't blow up, but I've spoken with a bunch of my sources, including bond fund portfolio managers in investment banks, that this did blow up in February and March. So they're going to copy the strategy because the claim is that over the long run, this will produce more returns. Well, this trading strategy also does blow up. And then now you have what looks like pretty clear and convincing evidence that the chief investment officer of CalPERS is also a Chinese Communist Party member and part of the 1,000 Talents program too. As you can see there, what I highlighted from the article. We'll see if other pension funds copy CalPERS, but I think this is an extremely dangerous precedent. Now, they are really, really desperate, and desperate times do call for desperate measures, but I think they're hoping that they can capture the profits of the upside, and the downside is a bailout from the Federal Reserve or the US government. So comment below the video if you agree with that, but I really do not like the trading strategy that CalPERS is planning. They're leveraging up the balance sheet. They're taking on more risk. They're going to be increasing the investments into private equity very late in the cycle. And in the risk parity trading strategy, if there's a lot of volatility in bonds with the amount of leverage, or some bonds go bad, it could blow up.